Great. Well, welcome everyone to our webinar on Startup Essentials, How to Make Investors Love You. My name is Sarah Aldersley and I'm a practice leader in LegalVision's corporate team. And I'm joined today by James Church, who is the co-founder and COO of Robot Mascot. Before we begin, there are just a couple of quick housekeeping items. So you will receive the recording and slides in your email, so don't worry too much about making detailed notes. If you have any questions, please submit them in the Q&A box while we're talking, and then we'll answer them at the end. And you'll be sent a feedback survey after the webinar. So please do complete this because it's really helpful to see what feedback you have. Also, all attendees are eligible to receive a free consultation with LegalVision to discuss how we can help you with your contracts or any of your other legal needs. So if you would like to request a free consultation, please just pop in your contact details in the survey that appears at the end of the webinar. So today we will be discussing, James will kick off and he'll run you through how to communicate your business opportunity to investors, finding investors and creating investment demand. He'll hand back to me and I will talk about housekeeping tasks to complete before actually reaching out to investors and negotiating deal terms and closing your investment. As I said at the end, we will be answering some of your questions in a Q&A session. So if you do have any questions, please submit them throughout the webinar in the chat function, and then we'll answer them at the end. So now I will hand over to James and he can tell you a bit about himself and Robot Mascot.
Oh, awesome. You've just ended slide control. It was
I'll
there.
put it back on. There
Awesome.
you go.
Cool. Brilliant. Well, look, thanks for having me. Really appreciate LegalVision inviting us to be part of this session today. So really excited to take you through this. We've only got an hour and I've got so much I'd love to say. So I will go through it quickly. Top level stuff. We'll then come to things in Q&A, so please do ask loads of questions, make it as interactive as possible, and you can go and find out more about what I'm going to talk about today in my book, Investable Entrepreneur. So I've written a best-selling book. It's called Investable Entrepreneur. You can get it on Amazon. You can get it for free on the Robot Mascot website. So that's going to kind of go into the detail of the top-level stuff I'm going to be able to talk about today. So do go and grab yourself a copy of that if you find what I have to say of any interest at all. A little bit about me and my business, Robot Mascot. I'm one of the co-founders at Robot Mascot, and we're essentially an investment readiness agency. We spend every day working with startups and SME owners and founders to help them prepare and position themselves for raising investment. And we've supported more than 3,000 founders to date. We've worked with founders from all over the world to raise capital, whether that be the UK, Asia, Africa, Australia, across Europe. And when they work with us, they're 40 times more likely to raise funding when they apply what I'm going to talk to you about today. They've secured more than 220 million to date as well. So huge amount of success. We're trusted by top tier VC funds, global accelerators and the like to help prepare founders for raising capital. Now we've won a number of awards along the way to validate what we do and our unique approach, which I talk about in my book. And really, the reason we do what we do, the reason we love our business and get out of bed in the morning is because we want to see great ideas and innovations flourish. And we just get so frustrated at seeing these incredible ideas that have huge potential, huge opportunity, fail to raise the capital they need to kind of make that happen, and have the impact that they want to have on the world. So our job is to help you better communicate your vision and your business opportunity to investors so that they want to back you and your business. Now, raising investment is not too difficult. It's pretty easy when you know how. And the trouble is, very few founders know how to do this. It's not even taught in business school. An MBA won't teach you. They'll maybe do one lesson over the 3 years on different types of capital for your business. And that means that the success rate of a first-time founder is about 1%. Less than 1% of founders successfully raise investment. But once you've already raised investment before, suddenly you become 48. You've got a 40%, 48 times more likely, a 48% success rate for your second round of funding. When you know the process, when you know what you need to do, how you need to prepare, and how you need to approach investors, it becomes much easier to secure the capital that you're looking for. Now, there's two things getting in the way for founders, and I call them the investment killers. The first of these investment killers is that founders struggle to convince investors that their business is the one that they should back. There's hundreds of deals, thousands of deals out there for investors to invest into. They must see hundreds of pitch decks every month. They invest in just a handful. I think the average is something like the average VC fund invests in one in every 150 deals they see. For a angel investor, it's about 0.4% of deals that they see they end up investing into. It's a tiny proportion that they from the decks they receive that they end up actually investing into. And our job is to solve that first investment killer, make sure that the deck that they see is the one that they want to invest into. Now, the second investment killer is, of course, finding the investors to send your deck to. Most founders struggle to find relevant investors. They don't know where to find them. They don't have a pre-made network of prospective investors that they can reach out to. So I want to kind of touch on how we solve these two investment killers today, because otherwise it spells game over for your investment ambitions, and we don't want that to happen. So as I say, it's not all doom and gloom, because today we're going to cover two kind of top level strategies that will help you solve these two investment killers. So without further ado, we'll look into the first investment killer, and we'll look at how you prepare yourself for funding before you even go out and start finding investors, how you prepare your business case for investment, how you can communicate the idea to them. So the one thing I want you to take away from today, this one core principle I want you to remember, is that great ideas don't raise investment, right? Great communication is what raises investment. So you'll probably see that when you, I don't know if you're part of an accelerator or an incubator, you see some businesses raise investment, and perhaps you think, well, no, they've not got a patch on what I'm doing, and they managed to raise. How come I'm struggling? And it's because investors aren't investing in ideas, they're investing in founders. They're looking for two things, right, fundamentally for an investor. Now, of course, you know, this statement is a little bit deliberately provocative, but of course they are looking for a great business idea, but there's always caveats that business idea needs to be in a highly scalable market, and they can see a future where this business concept is able to deliver them huge returns. So if it's a great idea in a mediocre or small market, then they're not going to invest, no matter how good the idea is. But of course, they're looking for a great business case, but they're also looking for an incredible founder. We can all have ideas. You've probably been around your parents recently, and your mum or dad has gone, I came up with this this should be a business. You should focus on this. This is a great idea. We've been down the pub with our mates who have all come up with these spontaneous business ideas, and everyone goes, that's brilliant, we should do that. And then no one ever does. Right? We can all have great business ideas. There is zero value in an idea. All of the value is in the execution. That's what investors are looking for, a founder who can execute on that idea that they believe can make it a reality, not just bring it to market, but scale it up and deliver them huge returns. So they're looking for two things: an investor, a brilliant business case that can deliver huge returns in a great scaling market, but a founder who can actually make that happen. Not a dreamer, not someone with a great idea, but someone who can execute and turn it into reality. So think of it this way, right? This is what tends to happen when founders pitch. Let's imagine we've got two people. They look the same. To an outsider, they might even sound the same, but one's speaking English and the other speaking French. So they should be working well together, but they're just not speaking the same language, right? One's speaking English, one's speaking French. And this is what's happening between investors and entrepreneurs, because investors, they tend to speak the language of risk and assets and proof and implementation. Whereas entrepreneurs, they tend to talk about opportunity and income and possibilities and ideas. And it's this communication barrier that means that just 1% of founders are successfully raising investment. So for an investor who's risk avoidant, when you go around talking about all the opportunities, it just sounds scary. For an investor that cares about the underlying valuable assets in the business, when you talk solely about generating income, they see it of little relevance. When they're looking for proof, the possibilities just sound like long shots. And when they want to talk about implementation strategies, the idea itself isn't actually that important. So investors aren't getting their boxes ticked when founders pitch. So who are they backing? Who are the 1% that are successfully closing rounds of funding? Well, I call these investable entrepreneurs. These are a cut above your standard entrepreneur. They're an investable entrepreneur. They're in the top few percent of founders. So what makes an investable entrepreneur an investable entrepreneur? Well, there's three things that an investor is looking for in a founder when they make a decision on whether or not to invest. First, that they're highly resourceful. They're able to get people to enroll into their vision. They can get people excited about what they're doing, which means they can attract capital, but they can also attract talent. They can also deliver game-changing commercial partnerships. All of these sorts of things happen to a founder who's highly resourceful, can pitch their vision really well. They're also, though, looking for a founder that understands the financial risks in their business. They also need to understand the potential rewards, but fundamentally, and in the short term, they need to understand the financial risks at play. How much is it going to cost to deliver the IP? How much is it going to cost to get to a point where you can launch to market? How much more funding is going to be needed in the future to scale up and grab market share from your competitors? You need to understand the financial risks involved in taking that venture forward. And then finally, they want to invest in a founder that really understands what commercial success looks like. That they're able and capable of building something that's going to be commercially viable, going to generate huge revenues, going to deliver investors a commercial return. And it doesn't have to be huge revenues. It could be valuable IP that you could go and sell on. It doesn't have to be get to a revenue generating point, but you need to understand how you're going to, what are the stepping stones in the short and the long term to delivering an investor the return on investment that they're looking for. And that return on investment is usually 10, 20, 50 times more than they invest today. So how are you going to deliver that 10 to 50 times return? What are the short and the long-term plans for making that happen? This is what investors are looking for. They're not looking for a great idea. They're looking for a founder that's all three of these things, an investable entrepreneur. So in order to do that, in order to express this to an investor, you need to be able to communicate these three things to them. And we do them via the three critical fundraising assets. That's what I call them in my book. And the first is, of course, the pitch. The pitch is the first thing an investor will ask for. And in that moment, they want to be inspired and enrolled into your vision. But they also want a nod to the fact that they're not going to be wasting their time if they were to take the conversation forward with you, because it's clear from that pitch that you have a deep understanding of the financial risks and commercial success. So they're happy to take the conversation forward and move on. So we need the pitch to demonstrate we're highly resourceful and that we're a credible entrepreneur that I can invest my time into for finding out more about this investment opportunity. We then have the projections. Now, this is primarily there to demonstrate to investors you understand the financial risks involved. It's all very easy for founders to just add loads of zeros onto the end of revenue as they forecast out their business, but very few of them accurately project the financial risks involved, the amount of cost it's going to take to get there. They get their metrics all wrong. They underinvest in marketing. They underinvest in staff. They're delivering too high a profit margin. And yes, you can show investors a profit that's too high, and then you become uncredible. You become something that it's all just a dream. This is never going to work in reality. We've seen this time and again. They're experienced investors. They've seen this with so many businesses and founders that think they can achieve these sorts of margins. They think they can achieve hundreds of millions in revenues with just a handful of staff, and the reality couldn't be further from the truth. So we need a credible set of financial projections to show that you understand truly the financial risks involved in growing this venture and how much capital it's going to take, as well as the potential rewards in the future in terms of revenues and future valuations. And then you will need to be able to demonstrate to them a solid plan, a business plan for success, something in the short term that says, here's the stepping stones, here's exactly what I'm doing over the next 12 to 24 months with your money to deliver our next strategic milestone. And then beyond that, here's our plan for scaling up and delivering value to the company, increasing the value of the company over time. And here's our longer term plan over the next 5 years or so to make that happen. Here's the different products we're launching, or the different markets we're moving into, the different parallel sectors that we're crossing over into. This is our strategy for longer term growth. So it's not until you have all of these things in place that you can truly start to demonstrate yourself as a investable entrepreneur. So we're going to very briefly look at this pitch ready journey. The plan, the projections, the pitch show demonstrating commercial success, financial risk, and that you're highly resourceful. And this is the order I would recommend you approach preparing for investment. Start with the plan, get the detail down of how you're going to execute this vision, then look at how that translates financially and how much cost is involved. And then you've got the foundation you need to go and create an incredible pitch. So very briefly, the key fundamentals you need to think about as you go through this pitch ready journey. Firstly, with the plan, you need to focus on the journey and not the idea, right? Focus on understanding the strategic journey you need to take over the short and the long term. So what do I need to do month to month to get to my next strategic milestone, which is normally your next round of funding or your break-even point where you no longer need any funding? But what's the stepping stones to spending this money right now? How am I spending that across key areas of the business? How am I spending it on staff and marketing and IP development? How am I spending this money? How long is it going to realistically take? And what's my clear plan of action? And then beyond that, what's the journey moving forward? As I say, different strategies for growing and scaling the business, but you need a clear plan on the resource you need to make that happen. So focus on the journey and not the idea. Investors couldn't care about all the features of your app, by the way. The slide that is going to spend the least amount of time on is the one that says, here's all the amazing features we've put blood, sweat, and tears into building, if you're a tech app or whatever. They don't care about that. They care about this stuff. They care about the market opportunity. You want to talk about your growth strategy, the market opportunity, the risks involved, but also the opportunities available. All of these sorts of strategic things is what they're looking for. So focus on the journey, not the idea. When it comes to your projections, the job of the projections is to create your future. No one is expecting you to predict your future. The job of the projections is to create your future. So most founders get a block when it comes to their forecasts because they're thinking, how can I know what's going to happen with my business in 5 years from now? It's all guesswork. And the reality is, yes, it is. Investors, the one thing you and investors will 100% agree on is that your forecasts are completely made up. That's kind of the whole point of them. But the idea is to show how you're creating your future. How are you spending money and where? How are you managing capital? How are you being a good custodian of their cash and making sure that you spend it in the right way and always have enough capital in the business to remain solvent? And yes, you want to show what the future revenues look like, but it's much more important. These forecasts are used by investors to get inside your mind and see that you're financially literate. You understand and can manage cash flow in an early stage because cash is king. Cash is the difference between you staying in business or going out of business. So you need to make sure that you're really showing a set of forecasts that look to create your future, not predict your future, and show what is genuinely needed to achieve success. And we're looking at this in terms of cash management and the way that we can engage various assets in the business to keep it moving forward. And then finally, you have the pitch, and the key consideration when it comes to your pitch is to pitch for time and not money. The mistake founders make is they're always pitching for cash. And when you think about it, that's not the job of the pitch. The job of the financial projections and the business plan is to close the deal in the meetings that will follow on from your pitch. The job of the pitch is to get the investors to open their eyes and go, this sounds really exciting. I'd love this opportunity. There seems to be a really solid strategic plan. These founders appear to be very credible and practical and able to deliver what they say. I want to invest my time in finding out more about it. And then only then will you close the deal. An investor's most precious commodity is their time. Right? They have the wealth. If they're an angel investor, they have wealth and they're looking to invest that into founders. That means they probably have 5 or more business interests already at a portfolio of companies that they're trying to manage, their own businesses that they have that they're working in or on. They have limited time. They have plenty of wealth, but limited time. The same number of hours in the day as you and I. So you need to pitch for their time and not their money. The hardest job is to get them to invest their time in finding out more about your great idea. The same is true for an investment analyst at a fund. They're flooded with an inbox full of pitch decks from expectant founders. And they have to filter through those and try and find the ones that are worth taking forward. Again, you're pitching for their time at that point, not their money. So that's the key, is keep it short, keep it concise, and pitch for time and not money. Get them to want to ask you questions, get them to want to engage in a further meeting. And the only way you can do that is by keeping your pitch short and engaged, and recognize they have limited time to make a decision. And anything over, do I have this slide? Here we go. Yeah, anything over 18 slides and 100 words on a slide is going to deliver you terrible success. So this is the sort of data we collect when we do investor outreach. And as you can see, the slides there that less than 18 slides, less than 100 words a slide, get 2.5 times the number of time spent per slide. So the less content equals more time spent viewing that content, because when there's loads of content, they just flick through and they just go, oh, I can't, I'll read that later. Or worst case scenario, they look at it, they go, oh, this is 50 slides and loads of content. I'll park that for later. And then later never comes because they're busy individuals. The same with the drop off there. When you have less slides and less words, you end up with, I don't know what's happened to the slides here. The words are a bit all over the place, but you get a 6 times higher engagement. 6 times as many investors make it to the end of the end of the deck than those that don't. I don't know why there's those numbers along the bottom. They shouldn't be there either. But there we go. Something's gone a bit wrong when I shared my slides here. But the moral of the story is less is more when pitching. You get more engagement if you can be concise and articulate with your language. So very quickly, because I know we're running out of time here, but I want to cover the second investment killer, and that's how to find investors to pitch to. Now, the thing is, investors hold all the cards. They see hundreds of deals a year. They invest in just a handful. So there's a supply and demand imbalance in the market. Just like the housing market right now, there is more founders pitching than there is the amount of capital there is to invest. So investors have all the choice. The job of a founder when pitching for investors is to try and switch that power balance in the favor and make sure that investors feel like there's FOMO in your round. If there's a fear of missing out created, if I don't invest in this round right now, I'm going to miss out because I know there's other investors interested in investing in this opportunity. And that makes it more exciting rather than just them being the only option. You know, investing's a lonely space for an angel investor. They're making a decision on their own personal wealth about a business that they know very little about, in all honesty. If they've got other investors who are also showing interest, that gives them the confidence that they're making the right decision. They feel safe in a herd. So you want to be creating a FOMO. You want to create demand in your opportunity, and you want to be able to have an excess of potential investors investing in your round. And that gives you leverage to negotiate your round. If someone's being tricky on valuation and trying to take too much equity, you can say, well, these investors over here value me at a better valuation, so I'm going to go with them. You're welcome to join in on their deal, but we're not going to be doing a deal where the valuation you're proposing, because we don't need to. We've got other investors that value us at a more reasonable rate. So this gives you the leverage you need to close your round. So how do we do that? Oh, I mentioned that already. We'll skip through. So how do we do that? We create a marketing funnel, just like any other campaign. This is just a sales and marketing campaign. The only difference is the product is your shares and the audience are investors. But otherwise, this is just like any other B2B marketing campaign. You want to create a funnel, you want to engage investors and work your way through the key aspects of a campaign. The first pitch, second and third meetings, and expression of interest before finally doing the due diligence and closing the deal. So here's what founders do when they go to pitch their business. They just sort of spray and pray to any investor that's listening, or anyone who will listen, just hoping that they might invest. And we don't want to be like this Rambo. We don't want to be this crazy person just spraying and praying, hoping for the best. We want to be more like this. We want to have a laser focused precision plan for targeting the ideal investors. So very quickly, how we do that is we create a target list. And we need to create a target list of people, of prospective investors and high net worth individuals who are in a similar industry niche and technology to you. You need to find people that have ideally invested in a business at a similar round size or stage of development to you are. And you want to be targeting industry leaders, exited founders, and of course investors. But not everyone is quote unquote an angel investor, right? You'll have professional angel investors that have angel investor as their title in LinkedIn, but then most angel investors are CFOs or CEOs of other businesses. they're very difficult to find. So you want to be building relationships and targeting industry leaders and exited founders in your industry, in your niche, building relationships with them first, and then trying to convert them into investors later on. You need to also then promote your investment opportunity to this target list, and you're going to need hundreds of people on your target list. Most founders think it's kind of 10 or 20 possible investors. You should be talking hundreds, if not thousands, of potential investors. Outreach tactics that work, and I see work regularly. Warm introductions, hands down, the best thing you can do to get a meeting with an investor is to find someone to introduce you to them. If you can't do that, the next best approach is large-scale email outreach via email, not LinkedIn. Email delivers a much higher response rate. Applications to funds and angel groups, of course, and using your network, your social media profile, perhaps, building in public, showing people what you're doing, and you'll find hidden investors and hidden introducers in your network. When you tell people what you're doing, they can't help but help. We had a founder do this in the real world. They went to church every Sunday, and they've been sitting next to the same bloke for about 18 months, and they've just been talking about the weather and the cricket and the football and all of those things. And after working with us, he excitedly said, I've had a great week. We're in a position where I've never told you before, but I'm building a startup. I've been kind of keeping it on the keeping it on the sort of low key, but we're now in a position where we're going out to raise investment, and we've just had our pitch done and we're ready to go, and I'm super excited. And he went, no way. I'm part of an angel group locally. I'd love to invite you in to pitch for our business. They'd known each other for 18 months. They already had this connection through going to church. So they had a personal relationship, and they just so happened to be the perfect fit, leveraging their network, both online and offline, to find hidden investors and hidden introducers. Things that don't work: connection requests on LinkedIn that say, I'm launching my seed round, I'm looking to raise X for my business. No investor is connecting to those. Public databases and mailing lists tend to be very outdated and not have relevant email addresses in them. So avoid doing those. When you're doing email outreach, only use paid data. Free data is useless. You're going to get a tiny percentage of those are active emails. Investment brokers don't work at an early stage. They just don't tend to, the economics don't work for them until you get to 5 million plus. Brokers don't tend to work. And relying only on your network, I know that kind of contradicts the point on the left there, but relying only on your network doesn't build enough FOMO in your round. If you have one or two people you know that you want to pitch to because you know they're high net worth and they'll be really interested in this, that's great. But you also want to do all the other things, a multi-channel campaign to bring in more investors so you can create that FOMO and you can negotiate yourself the very best deal terms. Because if you end up with one person in your network who says, yes, I want to be part of this, whatever offer they put on the table, you have to accept because you have no other choice, and you don't want to be in that position. It's bad for the amount of equity you give away, and you'll regret it in future rounds. So that's it. That's the pitch ready journey. We need the plan assets, the projection assets, and the pitch assets to prepare ourselves for funding and have the message we want to get out there to investors. And then we can execute a campaign plan to leverage investor FOMO and bring investors in our orbit so we can start pitching to them and start negotiating with them to close the deal. So just a final note from me: remember, investors don't back entrepreneurs, they back investable entrepreneurs. And now I'm going to hand back over to Sarah for her part of the session.
Thanks, James. I mean, that was really insightful. I know we get asked all the time from our clients, okay, I'm ready to go, but how do I do it and who do I approach? And obviously that's not really a legal question, so knowing there are people out there that are focusing just on that topic is really, really useful. So you may have kind of got your pitch deck ready, you're really happy with, you're ready to launch, go out to the market. But the first thing to start with is making sure that you do actually have a structure that an investor can invest in. So, often founders might have started their businesses as sole traders. You can't sort of give away a piece of yourself as such. So you do need to have a company. So you're receiving investment in exchange for giving away a part of your business. So in a company structure, that means giving away shares. So companies have share capital, which allows shares to be issued to give a certain ownership percentage right to shareholders. You might also want to consider your company structure. So right now, do you have a single company or do you have a group? If you're a bit more advanced and you sort of have multiple businesses or different arms to your business with the same ownership, then typically you might want each business to sit in a separate company, which is then owned by a holding company. This kind of gives you really good asset and liability protection. So, each particular asset in each company is effectively separated from the other assets in the other companies and liabilities that may arise with that. If you do have a group structure, just make sure that your assets are sitting in the appropriate company. So, for example, if you've got really key and valuable IP, typically that would sit up in your holding company. So it then becomes protected from any trading risks in your separate operating companies. So that's just something to think about there. So you've got your pitch deck ready, you've got your business plan. It's probably the less exciting bit to think about, but it's good to make sure that you've got kind of your housekeeping in order before you start going too far down the road with reaching out to investors. Kind of the more organized that you can show that you are, and the more you can show investors that you are complying with various legal obligations, the less of a risk that you will be considered by that investor. So most professional investors will carry out some level of due diligence, but it does really vary. We do see there are some angel investors that kind of don't do too much. So it's really going to depend on the investor. If you are being asked for a lot of information, then it's a good idea to establish some sort of data room, or at least kind of a shared Google Drive or a Dropbox, so everything can just be kept in one place and organized and then shared with the investor. Also good to bear in mind that these things do take longer than you think. So if you think about from when you first sit down and think, okay, I need to raise some capital, I need to get my business ready and sort out my pitch deck, work out what investors I'm going to approach them, if they're, have follow-up conversations, negotiate if they're interested. It can be anywhere from sort of 3 months up to 12 months from start to finish. So just be aware, don't leave it to the last minute to think, okay, I'm running out of cash now, I need to do something about this. Sort of think ahead, what is my plan here? And make sure that you are putting in place things well in advance of when you need them. So I'm going to run through kind of a few main things to think about from a housekeeping perspective. So one of the main things here is the cap table. So you probably all come across one of these. It's a document showing sort of who owns your company. Typically, it's in some sort of Excel spreadsheet form. So what needs to go on this are all of your issued shares, no matter what class they are. So that shows who right now holds what number of shares. If you also have an employee share option pool, then you need to put that on there as well. And what do I mean by that? So it doesn't necessarily mean that you've got kind of option documents in place or you've issued any options, but if you have authority from shareholders to issue a certain number of options to employees or shares to employees, then really that should be shown on there as well. And also, if you've done any kind of initial fundraising and you perhaps have any convertible notes or advanced subscription agreements in play, then they should also factor, because on completion of the round, they're likely to convert. So there will be a number of shares that will be ascribed to those instruments. It's also good to think about, are there any shares that you have promised? So, for example, to an employee or someone that's just provided some services to your company when it was early stage, that you haven't actually delivered on yet. So if that is the case, which we see quite frequently, to be honest, someone helped set up a website at the beginning and they didn't have enough cash to pay them. So they said, we'll give you 2% of my share capital, but they haven't actually done that yet. This should really be sorted out pre-investment. Because obviously, if you leave it till post-investment, you need to probably get investor consent to actually issue those shares. And also it would end up diluting the investor, which they won't want to happen. So it's a good idea to think about that and make sure you sort of got everyone on your cap table before you're reaching out for the investors. And so for the ESOP pool, even if you haven't issued any options, as I said, normally what you would do is put that pool on your table so that it gets factored in when you're working out the share price the investors will pay. Otherwise, again, they'll get diluted by any options that you do go on to issue. So they normally want to see that on there and make sure it's being factored in. So that's the cap table. As I had said, it needs to include any share class you have. So as part of that, you need to be thinking, what class of shares am I giving the investor? So typically, as a founder, you probably just have what's called ordinary shares. So you'll just have your standard kind of income, capital, and voting rights. So you may well be able to issue the investor with ordinary shares. That tends to be the case, if they're angel investors or friends and family, or perhaps they are relying on sort of SEIS or SEI or EIS investment tax relief. Then typically they may be happy to just receive those ordinary shares and sort of rank alongside the founder. But they may want what's called preference shares. So you might have heard of sort of Series A preference shares, Series B or seed, to go back even further. So they just tend to be different types of preference share depending on what round you're on. So the preference that attaches to this share class is that on a kind of capital event or liquidation of the company, the investor gets back their money first before the ordinary shareholders. Sometimes, not typically, but sometimes there is also a preference which attaches to dividends. They kind of get paid a preferential dividend in advance of the ordinary shareholders as well. You do see sometimes, tends to again be more sort of friends and family rounds, but where investors are happy to accept non-voting shares. So they'll still get all the dividend rights, they'll still get all the rights when the company is sold, but they just won't have any rights to vote as a shareholder. So as I said, this isn't typical for sort of your larger kind of VC and angel investors, but sometimes in a friends and family round, people are happy they just want kind of an investment from it. They don't want to get involved with any of the decision making. So it's an important thing to think about, because what class of share you give to your investor is going to impact sort of future control that you have over your business and the rights that you might have as an ordinary shareholder going forward. So the other thing to make sure you've done is you've got your cap table in place. Make sure that then matches up with your company registers and your company's house filings. So it's still quite old school, but there is a way you can tell Companies House that all of my information on Companies House is what it is. There's kind of no other information I'm holding elsewhere, but most companies haven't done this. And what that means is you do need to have a separate set of registers. That would be your shareholder register, director register, option holder, PSC register as well. So that technically, from a legal perspective, is the definitive record of who owns the shares, regardless of what it says on Companies House. So it is a good idea to be aware of that and make sure you've got a register going. And then separately, obviously, everyone looks at Companies House that's publicly available. If you're showing an investor a cap table that says all these people own shares, and then your Companies House filings just don't match up with that at all, again, that's where the investor's thinking, well, I'm not sure, how do I verify that what this person's saying is right in terms of shares? Are they missing anything else? So it's a good thing to make sure that your Companies House filings are up to date and do reflect kind of what has happened in the history of your company. So, for example, we see it quite a lot where you have to do an annual filing at Companies House. From one year to the next, the share capital numbers have totally changed, but there's no other filing in between those two confirmation statements showing how that happened. Clearly new shares probably were issued. There should have been a form that's filed to record that, setting out kind of what was paid for those shares as well, and that's missing. So that's something where we recommend that you run through and make sure that it is all concise and up to date. Also, if you've done anything particularly key in terms of your share capital, particularly, so things like share splits, technically these should have been approved by shareholders. So if you haven't already got the proper authorities in place that you needed to do that, then again, just recommending that you sort of make sure you're on the front foot and you prepare kind of a ratification document so that you can show a paper trail of yes, this was all properly approved. Great. So another important thing for a lot of startups nowadays is obviously intellectual property. A lot of companies now, are tech businesses primarily. So really a key asset is their IP. So I'm sure most of you know what I mean when I say IP, but it's effectively the intangible property right in the thing that you create. So it could be in a new product, it could be in software or a distinctive brand that you've created. There's different types of IP. So typically copyright is going to be your main one. So if you create software, really that's just a copyright IP interest. But there are also obviously trademarks and patents if you have a particularly unique idea. So on the whole, because kind of tech businesses tends to just be copyright, there isn't sort of any registration as such that you need to do for those rights. But what you do need to be thinking about is, okay, who created that IP? And so who owns it? Because obviously worst case scenario is you've got this amazing business, you've created something, and it turns out you don't actually own it because maybe, for example, you outsourced your app creation to a developer, and then they either didn't sign a contract with them, or the contract you did sign with them doesn't actually have anything in there about what happens to the IP. That IP could still be sitting with the developer, which obviously you don't want to happen. So make sure if you are sort of outsourcing anything where IP is being created, you have a contract with that person that has an IP assignment clause in there. And if that hasn't happened, putting in place some sort of IP assignment deed now to make sure that ownership is getting assigned back to you. And equally, if a founder started the business before they set up the company, you started as a sole trader, the chances are you've created quite a lot of IP that you are owning personally as the founder. It's not sitting in your company. Obviously, the investor's money is going into the company, so they want to make sure that all the assets are in the company structure. So it's an easy fix because obviously you're still involved with the business, so you would just sign an IP assignment deed to make sure any IP you own personally does get transferred over to the company. I'm equally thinking about any IP in the future. So you might have sourced everything out today, but making sure that, okay, if anyone else is working for me, what's going to happen to any IP they create? So that's things like your employment and contractor agreements having an IP assignment clause in them. Okay, another thing to think about are your commercial contracts. So by now you may well have key relationships with various stakeholders for you to have got your business off the ground. So for example, client contracts. So these would set out the terms of your relationship with your customers. Depending on your business, you might have a set of standard T's and C's that you use, or you might sort of have bespoke T's and C's for each customer. But where it's a really key client, we do recommend that you can show that you have something in writing in place. I mean, if it isn't a contract, it should at least be, an exchange of emails and not just verbal. So there is some kind of reassurance that that contract is in place and you understand when it can be terminated and your payment provisions and things like that. So ideally they should be in a kind of well-drafted contract, so you can sort of show investors, yeah, it's all watertight, I haven't overpromised anything, my business risk has been managed, and by having appropriate clauses in my client contracts. Equally, you may well have some key suppliers. So, if you have a supplier, if they stopped working with you, if it'd be quite difficult to replace them or at least replace them quickly, ideally you sort of lock down your relationship with those suppliers. So again, ideally in writing and have some protections for your business, such as how you can get out of the contract and terminate it, what warranties and promises that supplier is making to you, and making sure you understand kind of when you have to pay them and any circumstances where you might be able to withhold payment. And also NDAs. So if you are sharing key commercially sensitive information at kind of any stage of your dealings with a third party, then investors may want to see that you've actually properly protected your confidential information and entered into an NDA with that person to make sure that sort of your information that's key to your business has been kept private and out of the public domain. If you're entering into kind of client contracts and supplier contracts, then you don't necessarily need a separate NDA, but you can have a confidentiality clause in those agreements themselves. And then lastly, thinking about your employees and contractors. So if you have someone that's an employee, there are obviously additional rules that come with that. So things like, you have to pay them a salary that includes minimum wage. There are rules around paying them holiday and how you factor in overtime to that. You also need to make sure you've got in place a compliant pension scheme. And it's also worth thinking about, have I something happened that may mean that the company could be liable for any sort of workplace claims? Getting on the front foot of that before you start talking to investors, and also just making sure that you've got in place sort of your proper employment handbooks as well. If you're using contractors, which is very typical obviously for startups because you might not have the cash resources yet to actually be hiring employees and paying them minimum wage, just doing the analysis of, are they actually a contractor, or is there a risk they could be an employee and therefore I've actually owe them, I have extra liabilities, so I might owe them some additional money. As I said before, with contractors, making sure that they are assigning IP over to you. Great, so I'll move on now to sort of the conscious, we've sort of got 15 minutes left, so I'll try and whiz through it, but sort of what the steps would look like if you've got to the point where you have an investor who wants to go ahead with you, how you actually then get the money through the door. So you're obviously giving away part of your business. You need to think carefully about your company valuation, how much you're offering to the investor. You are giving away control effectively. So obviously at shareholder level, because you're giving away shares, but something that's important to think about is you are also potentially giving away control at the board level if the investors want a board seat. So I think a lot of clients we work with tend to get confused and think, well, I own 70% of my company and therefore I have control, but they're sort of one director out of three on the board. So yes, at a shareholder level, you have a majority stake, you have control there. But at a board level, and it's the board that make all the day-to-day decisions and management decisions, it's only kind of critical things, often to do with shares, that go up to shareholders. You actually don't have control at a board level because it's one vote per director. So in that scenario, you could be outvoted 2-1. So it's just really key to think about who's actually on the board and who should have a board seat. So main documents, first one is a term sheet. So you don't always have these. It might not be required, particularly if it's not kind of a sophisticated investor or the deal terms are very simple and you're ready to go straight to your long form documents. But you may well have a term sheet that sets out key details about the raise. So the round size, share price, kind of what share class the investor's getting, what share rights that attaches to, and any conditions that need to be met before you can actually complete like DD and shareholder approvals. They can be useful because if you have a negotiated term sheet, that can then reduce the amount of negotiation you need on your longer form documents, but typically they're not legally binding other than the confidentiality provisions. As I said, you don't necessarily need a term sheet. So the main kind of legally binding document is your subscription agreement. So this will set out the details of the investor, the amount they're investing, what price they're paying for the shares, any conditions to completion, like is there a minimum amount you need to raise before this investor's investment will actually go through, and also warranties tend to be the key things that's negotiated. So sort of James mentioned earlier about your pitch deck, and it's going to have forecasts in there that effectively are made up. So no one will expect you to warrant that I said in 3 years this thing will happen, so it definitely will, because obviously you shouldn't be given that kind of warranty because it's out of your control. But it will be things like, my forecasts have been built based on reasonable assumptions. They might want you to warrant something like that. And obviously any kind of existing accounting information you have provided, warranting that that's true. So yeah, that tends to be a large part of the negotiation as to what you're saying that you're happy to stand behind, and that the investor can obviously then claim if that's not true. It might be the case that you can have one subscription agreement that all of your investors sign, or you might need one per investor. It's going to depend kind of on the terms that everyone's signing up to, and if you're kind of completing in one go, or if you're doing the investment in tranches, so people might need separate subscription agreements. And then the other key documents are your articles of association and your shareholders agreement. So these will set out the key terms by which the company's governed. So as I mentioned before, if you do have separate share classes with different share rights, they will go in your articles. If you are giving away any board seats, that should also go in your articles and shareholders agreement. So particularly key here is thinking, as the founder, should you have the right to always be on the board for so long as you hold any number of shares? For investors, it might be that they should only have a board seat if they're holding a certain percentage, like 10 to 15%, say. The articles will also include things like your preemption rights. So this is where if any new shares are being issued or existing shares are being transferred, making sure they're first offered to the existing shareholders to prevent dilution. Also things like drag and tag rights, really important to think about these if you're looking at a future exit. You might want it to be the case that if a certain percentage of shareholders or founders sell or want to sell, then you can sort of drag any other minority shareholder into that deal. Investors often will agree to this, but they might have a caveat to say that they're not going to give any warranties to the buyer. They'll just say, yes, I own my shares, and then they get their cash. They don't have to sort of stand behind the same commercial warranties that you would have to as the founder. If you've also promised investors any particular information rights, like you're going to give them, quarterly accounts and updates, that would go in your shareholders agreement. And equally, if you're not giving them a board seat, but you might instead be giving them sort of veto rights, so particular key decisions, you might have to go to the investor and say, are you okay with this? That would go in your shareholders agreement, as well as things like founder restrictions. So you might need to have your shares subject to vesting. So if you sort of left within a certain amount of time, you might lose some of your shares, and also sign up to a non-compete. That's quite standard. And then lastly, there are some ancillary documents. So that's things like your board resolution approving that investment. You often do need shareholder consent because you're issuing new shares. So that could both be kind of authority to actually allot those shares in the first place, or perhaps getting shareholders to waive any preemption rights that they do already have. So if you already have quite a few shareholders, maybe you've done sort of a friends and family round first, do factor that into your time frame that you will need to go out and get shareholder consent in order to issue shares to the investor. And then after the round, you should issue share certificates and update your shareholder register and Companies House, like I mentioned earlier. So that was kind of a whistle-stop tour through the legal documents. And that's sort of the main part of our webinar concluded. So just a couple of additional slides here. So there's a link on this slide to our UK startup manual, which if you want to download. It's got lots of useful information in there for founders in the UK. We've also got an upcoming event that might be of interest. It's on how to expand your business into a franchise on the 25th of March at 11 o'clock. And then I'll hand back to James just to briefly run through kind of publications that he's got that could help you as well.
Awesome, thank you. Yeah, so if you are looking to raise investment over the next 3 to 12 months, and you want to kind of see where you're at in terms of your preparation and how ready you are to raise, you can take this short quiz. It's at pitchready.co.uk. It's completely free. Takes less than 5 minutes, answer a load of questions, and you'll get a free 12-page tailored report on how investor ready you are across the key categories we talked about today: your business plan, your projections, your pitch. Really looking to assess kind of how ready you are to go out there and start speaking with and finding some investors. You can also, as I said at the beginning, get a copy of my book, Investable Entrepreneur. If you take the quiz, you'll get an opportunity to get a copy of the book for free. So if you go to pitchready.co.uk, fill in the quiz, we'll send you a copy of the book in the post. If you're outside of the UK, it would be a digital copy, but if you're in the UK, we can get one in the post to you completely on us. We'll pay the postage and everything. So yeah, if you want a physical copy, go to Pitch Ready, take the quiz, and we'll pop one in the post for you. And then finally, just to say from me, look, what I talked about today is what we do day to day for founders. We have our Pitch Ready service, which is getting the materials ready, our business plan, projections, pitch materials, valuation reports, all of those sorts of things, letting you completely investor ready. And then we have Campaign Ready, which is our outreach service, where we outreach to thousands of prospective investors on your behalf, doing ghostwritten email campaigns. So as far as they're concerned, you've done all the heavy lifting, but instead we're managing that campaign for you. So we've got those two options. If you are thinking raising investment, you want our help, just email us info@robotmascot.com, and we're happy to book in a one-to-one to chat it through, see if we're the right fit, and take things from there. There we go. And then if you want to connect with me, that's the socials covered. And there we go.
Great. So yeah, if you do have any questions, do put them in the Q&A chat box now, and we've got a little bit of time so we can get to them at the end. While you're doing that, I'll just quickly run through how LegalVision operates, because we do actually have kind of a membership service, which is a cost-effective alternative to sort of an hourly rate charging that you may experience with other law firms. So effectively, for an affordable monthly fee, you get all-inclusive legal services, including things like unlimited document reviews and drafting. So, if you did have contracts needed us to draft or look at, then we could absolutely do that. Also includes unlimited advice consultations. So we have different teams of specialist lawyers, like business structuring, employment, disputes, commercial. So if you did have legal queries, you can book in for a session with the relevant specialist, and they can kind of help you work through your issue. And there's also unlimited domestic trademark registration included in that membership. So you effectively know that you've got your legal needs covered without worrying about kind of ongoing costs of lawyers. So it's effectively like an in-house counsel service where we'll sort of take care of your business as usual legal work, so you can just focus on running your business. It's sort of a cost-effective solution for outsourcing that work. So if you do want to learn more about this, yeah, as I said before, you can request a free consultation when the survey appears at the end of your webinar. So just pop your details in there and someone will be in touch to set up kind of a one-on-one with the team. So have we got any questions?
No
I think we
questions.
had one in advance that I'm hoping is answered because it was sort of a general question around kind of raising capital. So hopefully you found today informative enough to kind of understand a bit more about how you would go about that process and doing that. I mean, James, is there anything else that you want to touch on?
Yeah, I mean, I've got something that I can think of that, yeah, I'd love to know your take on. So obviously you mentioned kind of the importance of having those sort of NDAs in place, and investors will be wanting to see that you have NDAs in place with various people that know the ins and outs of your IP and your business. The irony being, of course, that most investors wouldn't be willing to sign an NDA before you pitch to them. So what's your take on that? When should you be triggering an NDA with investors, getting that balance between not kind of blocking the door to a conversation with an NDA, but also protecting yourself as a founder with your IP?
Yeah, no, that's a really good question. So, yeah, as you say, it's very unlikely you're going to have an investor sign an NDA before you're going to pitch to them. But, you know, if your pitch is successful and you're moving on to the next stage and you are perhaps sharing a lot more information with them in a data room, then, I mean, there are actually kind of clever ways where you can actually kind of attach wording to your data room. So anyone getting access to that is effectively signing up to not sharing any of that information, as opposed to sort of more blatantly giving them a separate NDA to sign. So there are sort of more clever, nuanced ways that you can do that. But I would say, you know, that's an appropriate point. Obviously, you know, each situation is different depending on the relationship you've established with that investor and trust, and if you think it's appropriate at that point to ask for an NDA. But you know, you are giving them access to a lot more information, you know, particular contracts. I mean, again, it's going to depend on who that investor is. You know, you were saying before, quite a lot of the time it can be quite neat to reach out to people in the industry who are perhaps ex-founders themselves and might have some spare cash knocking around that they want to sort of invest in your business. So, you know, also bearing in mind what's the risk profile of this person sharing this information, and if they are in the same industry, obviously that's going to be a higher risk. So it'd be more appropriate in that circumstance to say, you know, I'll give you access to my data room, but don't really want them seeing all of your key contracts and understanding your pricing structure and things like that. You know, getting more of a deep dive into your software as well without them having signed that NDA.
Yeah, cool. No, that's good. That sort of aligns with the advice I give when asked is, you know, frankly, if you feel your idea, your business can be copied off of your pitch deck, one of two things has happened. Either it's not actually that valuable at all and it's far too easy to replicate, or you're sharing too much in your pitch.
Yeah. Yeah.
So as a founder, if you're worried about sharing and protecting yourself, it's normally actually down to that you're sharing too much too early, and then that NDA comes when you're starting to have more detailed conversations. That's kind of the approach we've always suggested, with a big caveat of check with a proper lawyer, because this is not legal advice, caveat on it, but it sounds like it aligns with your approach.
Yeah, definitely. As I said, you know, it's risk management at the end of the day. If it's not as big a risk, or you're not actually giving away that much information, you know, we see pitch decks all the time, and could I copy that for somebody? No, I couldn't just go away and start their business.
The other thing that I find quite interesting about this as well is founders love to get NDA signed to protect, that feels like it protects them. But what's something that was said to me? I said, that's a good point. Look, the NDA is only worth the paper it's written on unless you can afford to actually enforce it, right? So if you can't afford to take someone to court for breaking, like, how does that work? Is that true? Is that, or are you protected, or do you need to have buckets of cash in to enforce it?
Yeah, look, if you actually needed to enforce an NDA, the ideal time to do it would be before that information has actually leaked enough. You know, you may get a heads up that this is happening and someone's actually starting a rival business based on your idea but haven't launched yet. That would normally be when you would try and seek an injunction, but that does involve the court. So obviously that's not going to be a cheap course of action to go down. So you would typically see that's going to be on more established companies that are able to
Mm.
afford that. Ultimately, look, I think it's good as a deterrent. Obviously, it doesn't actually, if somebody wants to then go and use your information and share it, then they can. Obviously, they've breached that NDA, but you do have that in place there. You have that decision, and you can involve lawyers. It doesn't often go to court. As I said, it's very expensive, but there can be that initial stage where you have it on paper that they shouldn't have done this. They've breached that NDA. You've got a legal letter going out from your lawyers to say, stop doing that. That can often be enough to put someone off. So you don't always have to go all the way to court for that to be a useful document to have in place.
Okay, cool. No, that kind of makes sense. And I think the moral, really, what I'm getting to is that there's inherently a risk, right? As a founder, and the way you can mitigate that risk is being, having, if you should be pitching for investment 12 to 18 months ahead of, you'd have done 12 to 18 months of development, IP creation. It shouldn't be that easy to copy, and you're mitigating the risk in that sense. And if someone tries to copy it, they should always be 2 years behind you anyway. So it's just worth thinking about as a founder as to how much do I want to rely on an NDA versus how much do I just want to crack on, get the funding, move forward, take that risk that comes with being more open with my idea and not just keeping it to myself and keeping it in private, because actually sharing stuff often leads to greater success, I find, because you bring people on that journey with you, you open doors, so keeping things secret isn't always the best thing to do.
Yeah.
If
angel investors wanted to copy every idea they saw, they wouldn't have any time to do that.
Yeah, and they wouldn't be angel investors. Like most angel investors have reached the point where they don't want to do that, and they want to pay you to do it, right? They want to be a shareholder to get you to do the legwork. They don't want to do it. And imagine how you would feel as a founder if your investor came along and said, "I've just been pitched this by someone. I want you to drop everything and start recreating what they've done." You'd be like, one, who's this investor, and why did we have this person on our team? And secondly, you'd go, no, we're focusing on this is our vision, we don't want to copy what they're doing. So the chances of that happening are highly remote. We've got a question here, how to decide how much to share. I'm guessing kind of valuation, how much equity to sell. It's a great question, and it's a difficult one to balance, right? Because as a founder, you probably you feel instinctively that you want to give away as little as possible, because you want to retain as much ownership for the future. And also, you need to think about being diluted in future rounds of funding if you need it, and not being in a position where you own too little of your venture come the end. But equally, you need to get the cash on board, and you need to have an offer that's attractive to an investor, so you can get the funding to even be in the position where you have shares in the future that are worth something. So it's a difficult balancing act. I think the general rule of thumb is, if you look at £1 billion worth of data, for pre-seed, seed, and Series A rounds, it averages about 15% per round, which seems reasonable. And when you talk to VC funds and angels who are calculating their fund and how they want to get a return, and they're looking at the kind of failure rate of their investments and kind of the return on investment they want to get and all of those things, and they're calculating their thesis, you tend to find they land on we need to have around 15% of every business we invest into if we are the only investor in the round. If we're taking the full round, we need to have 15%. And by the time we're diluted after a few rounds and the business is 20x in value, we'll be able to deliver our investors the 3 to 5x return that they're looking for. So everything seems to sort of trend towards 15%. I think the reality is that across those 3 rounds it changes. So pre-seed, I would say, is closer to 20%, seed 15%, and Series A closer to 10%. So you're rewarding those early stage investors when they're backing you, where you have the least proof and you're at the higher risk. You're rewarding them for their backing. So you want to pitch it and position it in a way where you can demonstrate the value that you're pitching, that this IP, this business is valuable right now. Understanding that you want to be showing, if you're pre-seed, you want to be showing kind of 20% equity to kind of really say, look, this is a reward essentially for backing us at our earliest point in time. and taking that risk on us. And I think that tends to be the right kind of balance, is sort of 20, 15, 10 as you go through each of those rounds. But it could easily be 25 to 30% in some cases for an early stage round. It depends on how much you're asking for. This is just average. If you're asking for lots at an early stage, then you need to be prepared to give away more. So you really want to have a robust calculation of your valuation using multiple valuation methods to kind of back up those numbers. But as a general rule of thumb, you should be expecting to give 15 to 20, 25% of your company away at an early stage, I would say.
Yeah, that's consistent with what we see. And also I'd think about, how much runway do you need? There's no point going through all this effort and going for this raise and actually not asking for enough because you're worried about the dilution, and then finding that, this will likely iron itself out in your discussion with investors, but you're going to run out of cash too quickly and then be back at square one having to do the process again. So you want to make sure that you are asking for enough to make it work for your business plan.
The other thing to consider as well is obviously we talked a lot about investors doing due diligence on you. You want to be doing your due diligence on the investors as well, and you should be asking them to give you introductions to their portfolio company so you can pick up the phone. We've had some founders dodge a bullet picking up the phone to some portfolio companies, and they go, worst decision we ever made, do not have them on board as an investor, they're a nightmare, right? So you want to be doing your own due diligence on them. I think it says a lot about an investor if they argue about your valuation. If you're going in at 5% and they're expecting most deals at 15 to 20%, sure. But if you're going in at 15 to 20% and they start saying they want 30 to 40%, then I think you find yourself with an investor that probably isn't on your side, right? There's going to be constant conflict. They don't see the value in what you have to build. They're all in it for themselves. They're not looking at this as a team sport. And ultimately, an experienced early stage investor will understand that there is many rounds of funding to go, and the last thing they want is for you to feel over diluted, because if after 2 or 3 rounds you feel like you've sold 60-70% of the company and you've only got 30% less, where's your motivation coming from to build this business? And then you're going to leave if you can, based on the sort of documents you've signed, but you're going to do your best to leave, to start up a second business, not make the same mistakes, and their investment is gone. You've just gone, I can't be bothered with this, I'm winding it down, doing my best I can to get out and start again. And that puts them in a really difficult position as well. So as an experienced early stage investor, pre-seed, seed, series A type investor will understand the kind of future dilution and kind of the motivation of the founder, and making sure that there's that balance between them getting the returns they're looking for while the founder stays continually motivated that the work they're putting in is going to deliver and yield a decent kind of exit come the end. And then the final point to note is just to say, look, if you know how many rounds, or roughly can kind of guess it to how many rounds you might need by looking at peers that have gone through a similar journey. If you know that what you're building is going to take 3, 4, 5, 6 rounds of funding to get there, then you have to expect that by the end of that you might own less than 10% of your company. But that 10% could be worth hundreds of millions on its own versus 100% of nothing right now. So you have to be willing to dilute yourself, knowing that you're going to have a smaller share of a much larger pie. So don't make the mistake of trying to keep too much to yourself, but also don't make the mistake of giving away too much so that you're not motivated enough to build the company. And that kind of Goldilocks zone seems to be around the sort of 15 to 20% market at any given round, I would say.
Brilliant. Well, hopefully you found that really informative. Thanks very much for joining us. And yeah, make sure you download the different resources that we've put on the slides for you to help you, and good luck with your funding journey.
Yeah, best of luck, everyone. Thanks for having me.